Good afternoon, everybody. Thank you, Sam, and thank you to Bankers Online for the opportunity to do this webinar this afternoon. I thank the group also for spending some time out of your busy afternoon with me to talk about stress testing. We're going to go through the slide deck. Sam mentioned that I'll try to break midway through, depending on the length that it goes. But there is a lot of material to discuss this afternoon. As you can see, I kind of sat back and thought about the entire topic, and it really kind of fits into the who, what, when, where, how, and why scheme about community bank stress testing. Just to tell you a little bit about myself, I work for Bankers Toolbox. We have a product that does stress testing, so I get to work with many bank customers on this exercise, and it gives me great experience because no two banks are alike. Each portfolio is unique, and we customize this exercise for that particular bank. I also get to work with a lot of banks that are considering doing this exercise and maybe are performing it in another way, usually manually, and try to help them out as best I can. I do get contacted by banks through my website and through articles that I've written. So I do try to help as best I can to any institution that does contact me. My background is I'm a former FDIC examiner in both the New York regions and the Atlanta region for about 9 years. So I have both a safety and soundness and a consumer compliance background, and as such, I have been able to continue my regulatory contacts, and I also get to teach, if you will, the regulators through presentations to their groups. So I've pretty much traveled the country teaching stress testing to the field staff. Last year I spoke twice in Washington for the FDIC, so I do get a lot of feedback from them, and I try to incorporate it into training and articles that I write. So Sam mentioned that you can submit questions, and I'd be happy to take those as well. So let's move on. Now, what is stress testing? I think the best definition comes from the OCC handbook, and it's the Loan Portfolio Management Handbook, and it says that in stress testing, a bank alters assumptions about a loan, and it's one or more financial, structural, or economic variables. And the goal of this is to determine the potential effect on the performance of that loan, the concentration, or the portfolio. This comes from the 1998 handbook. The OCC has very good handbooks, and they are public information, and they are on their websites. From their newer handbook, why are we performing stress testing? Traditionally, credit risk management really was just the supervision of one individual loan or even just a group of related loans. But we have found that portfolio management really needs to encompass the management of concentrations or pools of exposure, because the collective performance of the pool has the potential to affect a bank negatively, even if that individual transaction within the pool was soundly underwritten. Now, some of the regulatory guidance surrounding this exercise, this slide and the next slide will give you the regulatory guidance And I tried to put the link in the slides as well so that if you want to refer to it, you can simply put the link into your browser and download the material. Now, on this particular slide is from the 2006 guidance, and this was joint guidance by the OCC, the Federal Reserve, and the FDIC. It really is still the reigning guidance, if you will, for the FDIC banks and the Federal Reserve banks. Now, within that guidance, it defined the supervisory criteria as 100% and 300%, and I'm pretty sure that everybody has heard this, but I did want to reiterate this again because examiners still refer to this, and unfortunately, if your bank were subject to some type of enforcement action, this is usually what is cited in that document. So the 100% refers to construction and land development loans. So 300% refers to the total CRE. Now this will include your multifamily as well as your investor CRE, and you can find these amounts on Schedule RCC, which is the loan schedule of a bank's quarterly call reports. Some more guidance that is out there. The Comptroller's Handbook was updated in December 2011, and that's the Concentration Handbook. That is a very, very good piece of reading on this topic, and I recommend that any bank, not just national banks, take some time to read that document as well. Last year, the FDIC, in their Supervisory Insights magazine, they issue that usually twice a year. There was an article about stress testing credit risk at community banks. It really was a very short article, very general, but I did include the link at the bottom of the slides for you in case you wanted to read that publication. Now, also the Comptroller of the Currency, October 2012, issued new stress testing guidance for national community banks and federal savings associations. Hopefully, if your bank is regulated by the OCC, you have already read this document. I do recommend any bank really reading this document. It is good general knowledge for everyone, and the link is at the bottom of this slide as well. If you would like a summary of that OCC guidance, I wrote an article for the ABA Banking Journal, and the link is on the slide. It gives you a summary of the OCC guidance. Now, the OCC guidance it's fairly short. It has a couple of appendices, but it does say that every bank should be performing stress testing, and it does not refer specifically to CRE loans. It is meant as a holistic exercise. So if you have a concentration in residential mortgages, then that guidance would apply as well. Now, with the release of the OCC guidance, they also issued a tool that is on their BankNet website. So if you have a login, you can download the tool. But I also wanted to mention, and I don't know if this is general knowledge or not, but the OCC also has a tool for their examiners, for their field staff. And they can use this tool while performing an examination in your bank. Their tool is a stress testing tool, and it also has some proprietary data in the tool through a partnership with some CRE providers. So they have within their tool economic data. So they can update collateral values using this tool. using the series indices